Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are going into a major day for the US markets with the US election today. Even though we may not necessarily get official results here for a couple of more days, markets are certainly anticipating the results of the US election for um, some direction of outlook. You also have the FOMC meeting this week following the US election. And just we still have earnings season to wrap up here. So a lot of uncertainty packed into this week's markets, especially after last week's poor jobs numbers that came out on Friday. Let's take a look at kind of where markets currently sit and what our outlook is as a result of that. If you look at the S&P 500, we've pulled back to what is effectively the breakout level to new all-time highs. We broke out to that 5,700 all-time high back here in September, traded as high as, just shy of 5,900, and now we're pulling back to that 5,700 level. It's important to remember that that level also corresponds to that 50-day moving average. We really need to see these levels hold on in order for bulls to maintain control here for the markets. But we have seen a little bit of weakness here from the equity markets heading into the test of 5,700. And the concern is that if we break below that, we certainly return to a more neutral stance here for the equity markets. And, that would, at the moment, align with what we're still seeing in price action with the NASDAQ 100, which has failed to make a new all-time high alongside the S&P 500. We would need to see the NASDAQ 100 break out to new all-time highs, confirm an S&P breakout to take a more bullish stance here in the market. So even without the S&P 500 breaking below 5,700, we already are taking a more of a neutral tone here with the markets. Well, as the Nasdaq 100 and the Russell 2000 both fail to reach new all-time highs. You have the Russell 2000 failing at that 227.5 level here as well, here to the upside. You can call that a bit of a triple top here, but overall, small caps not participating in the broader move here. You do have the equal weight S&P 500 breaking out higher here, confirming those all-time highs in the S&P 500. However, it is also testing that 50-day moving average and potentially breaking below some major support levels here as well. So even though participation in the S&P 500 has been relatively broad over the past few months, we're starting to see that reverse a little bit here over the last couple of weeks. We'll see if that can continue, if the broadening out of the S&P 500 can continue going forward, or if that's a sign of a potential pullback here for U.S. equities. So we'll continue to monitor that. But like I said, when you look at the three equity markets on balance, there's much more of a neutral tone here to the equity markets right now, rather than a straight outright bullish stance at the moment. If you look at growth versus value over the past couple of months, we started to see growth start to show a little bit of outperformance here after what has been nearly 3 months of effectively no outperformance from either factor. Over the last couple of weeks, like I said, we're starting to see growth come back to life a little bit, especially in the higher interest rate environment that we're in. Value stocks seem to be taking a pretty significant hit right now, which puts growth type stocks slightly back in favor given kind of where we are with the interest rate environment at the moment. So that's currently driving some inflows to growth stocks. And then if you look at commodities, we've seen gold and silver largely moderate a little bit in the sense that gold, after reaching our 2,700 upside target, getting as high as around 2,800, has started to consolidate a little bit. Oil has bounced off of the high 60s low that we've seen here, which provides a little bit of constructiveness to oil, but overall commodities a bit of a mixed picture here at the moment. Now, HYG, this is one that I do think is an important chart to pay attention to here because over the last couple of last, call it 5 or 6 weeks now, we have seen HYG start to trade a little bit lower here, especially as yields started to climb. And, this isn't particularly a risk off signal yet, but we've seen this divergence here between bond prices and equities, where we started to see bond yields rise, which starts to put into question some of these higher yielding names and their ability to survive. Another round of debt financing, and if they keep kicking kind of that debt financing down the road, how much would they have to pay in terms of interest income becomes or interest to service that debt, becomes a concern for both corporates as well as government treasuries. So as interest rates rise, the high yield market is starting to show a little bit of softness here, as we kind of flirt around that 50-day moving average. If it breaks below that, that could be a sign of some further weakness ahead at the moment. We haven't seen that contagion spread just yet, but that is one that I think is important to keep an eye out on in case that it does going forward. Now, the VIX continues to trade at a relatively elevated value, around 22%. Like I said, that's reflecting a lot of the uncertainty that we currently have with the US election, the FOMC meeting this week, earnings season that's still kind of wrapping up, and a job market that is quite um what's the right word? Uncertain here right now because we had August and September numbers come in fairly weak. October numbers, sorry, I meant July and August numbers coming in fairly weak, September numbers coming incredibly strong, and we're looking for those October numbers to give us a better sense for whether July and August were more true numbers and September was an outlier, or, we've seen a bit of a reverse in fortunes with the job markets. And, we had a pretty poor reading last Friday with the job numbers, but a lot of that can be explained away with the strike happening right now with Boeing, which, as of yesterday was technically resolved. And, 33,000 workers go back to work, I think, this week. And then you have the two hurricanes, the two back-to-back hurricanes that would have had a pretty substantial effect on corporations' ability to hire during that time. So, both of these are temporary. So we expect those numbers to recover quickly or recover effectively in the next month numbers. So we didn't get a very clean reading this particular month as to whether job openings were or job hires were relatively robust or there's still some overall softness here. We'll get a little bit of a glimpse here in terms of the weekly data, but it'll really be another month before we get a clean understanding of kind of where the labor market stands. And this is an important input into the FOMC's meeting later this week, but more importantly, going into December and the rest of 2025 for them to communicate what their expected rate cuts, the path for rate cuts are going to be. Job numbers are an important part of that particular calculus. And at the moment, there's a lot of uncertainty, which is why we continue to see the VIX trade, in that 22% mark, which reflects, angst. It reflects kind of concern here from investors with regards to kind of where they expect volatility to be over the next 30 days. 10-year yields continue to climb. We're currently hovering just over 4.3%. This is despite the fact that, equity markets are expecting a 25 basis point cut this week and then another 25 basis point cut here in December. Borrowing costs have continued to rise as treasuries become under pressure here. This is something that's important to pay attention to as to whether this 10-year yield stops rising around this 4.3% level, which certainly feels like a more neutral state here right now for bonds. But at 4.3%, this is a concern for equity investors because it makes treasuries or bonds far more attractive relative to the S&P 500 in risk terms. If you can get 4.3% in technically riskless assets in the US Treasuries versus, the roughly 2% yield that you're getting from the dividends from equities and then the equity premium, the question is whether or not you're getting enough premium from equities to justify the risk. And the higher the interest rates on bonds, the less attractive equities become as an asset class in the short run. And I think that's part of why equity markets have struggled a little bit over the last couple of weeks. And until we see interest rates decline, we can see equities kind of continue in a more of a slump, as we've seen here over the last few weeks. TLT, as you can see, trading down into that $91 support level, which has been a major support level here for a while. There does seem to be some signs of stabilization around this $91, $92 level here, which certainly provides a bit of an opportunity for buyers to start stepping in for US Treasury bonds, especially as yields climb and look fairly attractive. And the US dollar has settled now between that 103.50 and 104.50 level, consolidating after which is a strong rally here from that $100 support level into that 104.5 resistance level. We do expect a bit of a pause. If we do start to see interest rates decline a little bit, that provides a catalyst for the US dollar to start weakening a little bit here again, which would be a bit of a relief for a lot of other foreign currencies at the moment, but right now the US dollar remains incredibly strong. And then looking at kind of the overall sectors, there was a fair amount of rotation here that we've seen here over the past couple of days. Yeah, I'll do a quick update in terms of gold and silver. We talked about that briefly here before. Gold has pulled back to that 2750 level after reaching 2800, which was our upside target here for gold. You have oil forming this triple bottom around 67, providing a little bit of support here, breaking out now above the 50-day moving average, which certainly opens up oil into into that high 70s range, 77, 78 upside target here for oil. And then looking at kind of the sectors, you have um, financials, which is one that's, I think, worth paying attention to here right now. You have financials that have started to show a little bit of outperformance here relative to the S&P 500, especially as yields continue to climb. Financials have benefited from that. Communications as well. We've seen a pretty significant inflow into communications over the last week or so. This is more due to earnings than anything else. And then you also have healthcare. Healthcare, a more defensive sector, gaining a little bit of ground here, even though healthcare as a sector has lost quite a bit of ground over the last few months. This week, we've seen healthcare provide a little bit of defense here as markets pull back. So if you look at kind of what's performing here at the moment, not quite offensive nature here from the equity markets, far more of a defensive tone here. And at the same time, some of the more defensive sectors, such as if you look at utilities, you look at real estate, both of these sectors have seen a bit of an outflow here from the S&P 500, and semiconductors is the other sector that I think is worth mentioning because semiconductors over the past few months have really failed to break out to new all-time highs. And this is despite, kind of what you would consider insatiable demand for AI. Semiconductor stocks seemingly have a lot of that optimism already baked in because no matter what good news we hear out of kind of the relatively strong demand side of things for AI related, especially from a chips perspective. As a sector, as an industry, it has failed to kind of continue to outperform here. And that really has to do with the fact that this is a industry that trades at a relatively rich valuation. The upside in this particular case, given its current valuation, is somewhat limited, especially as investors become more sensitive to the valuations that these semiconductor stocks have continued to trade in over the past few years. And I've really started to question as to whether or not those valuations make sense, especially if the outlook for how tech companies are going to be spending to dominate AI is looking a little bit uncertain, with Microsoft and Meta both showing some weakness here this particular earnings quarter. You have Apple showing some weakness here over the last couple of days as iPhone sales have been in a bit of a slump. Apple Intelligence has not quite been the savior that they've been looking for. Certainly not with the latest release that they just had for Apple Intelligence. There's definitely some room for improvement on their AI products. And for those reasons, iPhone 16 sales have struggled a little bit, which has been a primary driver of the stock price and its valuation, but also just, what Apple has staked its future in, which is AR. With the Vision Pro, they just have not sold those headsets well. They've cut sales expectations in nearly half here for 2024. Developers are not developing apps for the Vision Pro, and it's a bit of a catch-22. When you don't have users, you can't source developers. When you can't source developers, it's hard to get users to buy your product. Meta has recently launched kind of more AR focused glasses, and Apple feels very much like they're pretty far behind on this front, even though they have technically spent hundreds of $billions in the last 9 years developing kind of the Vision Pro and what the future of that means for their business. At the moment, that future looks somewhat uncertain, and I think Apple trading at 29 times forward earnings is a concern here. And that leads us to our first idea here for today, which is Apple. Apple trades at 29 times forward earnings, which, in an environment where AI is going to produce strong upgrade cycles of their iPhone 16 makes a lot of sense. That was baked into the optimism of the price. It's becoming clear, more and more clear that AI product is still a few evolutions behind. They just released an Apple AI product or software release last week, which was largely very underwhelming and did not include any of the things that they were marketing kind of the Apple Intelligence with. And as a result of that, equity markets have kind of punished Apple as a result of that. So I think at the moment, Apple more of a neutral to slightly bearish tone here in the equity markets. And Apple is our first bearish idea here for today. The next one I want to take a look at here is Disney. We've been talking about this stock here for the past couple of weeks now. It's been consolidating very tightly between 95 and 97.5. We're looking for that breakout here to the upside, like we've seen with communications overall, after what has been a stock completing what looks like a bit of a bottoming formation. And this really comes down to the streaming business, Disney Plus, doing a pretty good job at executing a turnaround in that particular business. Cost cutting is coming in faster than expected, and Disney is expected to turn a profit on their streaming business in fiscal year 2024. And so that's positive news from the streaming business. The theme park business, showing some concerns earlier this year, have seemingly remained fairly resilient. And Disney, trading about 18 times forward earnings is a relatively inexpensive relative to the market and even to its industry. especially given their growth rates are largely in line with the rest of the industry and their margins are better than the rest of the industry. I think that there's the opportunity for Disney to start trading higher from here. The next one I want to take a look at here is Johnson and Johnson. Um, we've been looking at Johnson and Johnson here for a few weeks now, and after trading, higher here, we've pulled back here to this 158, 160 support level here. And we're looking for a continuation bounce here on Johnson and Johnson. This is more of a pure technical play here for healthcare. We've seen a bit of a inflow into healthcare as a more defensive sector. And from a valuation perspective, Johnson & Johnson very much looks fairly valued given where we're currently looking or we're currently trading here at the moment. At the same time, another healthcare stock that I think worth paying attention to here is Bristol Myers. We've been looking at Bristol Myers here for many months now. We finally got the breakout here above 51 consolidated here, and now it's broken out here again here to the upside. So that's a new 52-week high here on Bristol Myers recently. From a valuation perspective, it trades at about 7.5 times forward earnings, which is relatively inexpensive. And growth expectations are fairly strong, substantially stronger than the rest of the market. The only difference is that Bristol Myers is just coming out of a few rough quarters with regards to profitability, but expectations are that over the next couple of quarters they will return back to profitability, and with a growth rate that is nearly double to triple the industry average, when it trades at 7.5 times forward earnings, when the rest of the industry is trading at about 13, provides a fairly substantial amount of upside opportunity here for Bristol Myers. The next one I want to take a look at here is Lululemon, athleisure wear stock. Lululemon also, over the last year or so, has shed a lot of its value here, but recently has kind of arguably formed a bit of a bottoming formation that is, you could say that that's been completed, and we're now looking for a constructive move here to the upside. As you can see, over the last few weeks, it's outperformed the S&P 500. Its momentum has started to turn positive here, and Lululemon it does trade at a relatively rich valuation. That is one thing to be aware of. Trades at about 21 times forward earnings, even though it's expected to grow either in line with the industry or faster than the industry. But more importantly, it is far more profitable than the average stock in its industry. So for those reasons, it deserves to trade at a higher valuation. I don't think this is the type, I think the market, investors went a little too far when they took down this stock from 500 into the, low 200s. And now they're finally kind of working their way back to a more reasonable valuation here at the moment. One idea that I do also want to point out here is Adobe. We've seen Adobe as an AI play be a fairly volatile name this particular year, but I still stand by the fact that Adobe is one of the few companies that actually has an AI product that they're monetizing right now. Most companies that have quote unquote an AI product are still in kind of that R&D phase. They're still in development phase. They're still trying to figure out what ways they can monetize it and use it to drive revenue. Adobe is very much, out there already selling a AI related product specifically to professionals and illustrators. And yes, there's a lot of competition in this particular space, but I do think Adobe is head and shoulders above in certain areas, especially from the commercial perspective. For larger enterprise clients, their product is just something that's more polished for the needs of larger enterprise clients. And I think for those reasons, Adobe is worth paying attention to, especially as it kind of trades near its 52-week lows. It's oversold on both daily and weekly timeframes, which gives us a higher probability of a bounce. And we recently saw some positive divergence here as well. Negative lower lows in price, no longer being confirmed by lower lows in momentum, which generates the potential here for some upside for Adobe. And then looking at some bearish opportunities here as well. Another one I want to take a look at here is Costco. We've been following that for a while now. Costco has kind of traded sideways for the better part of nearly 3 months now. And as equity markets move higher here, and Costco trades sideways, that's actually underperforming the S&P 500. So a bit of a silent underperformance. And that leads us to a potential for adding some bearish exposure. And the valuations on Costco just remains fairly ridiculous. It trades at 50 times forward earnings. Yes, it grows faster than in the industry, but not by much. We're talking marginally faster on both EPS, both top and bottom line. But Costco is also far less profitable than the average stock in its sector. So given those kind of growth and profitability metrics, I think it doesn't make a lot of sense that Costco trades at nearly 150 times, I'm sorry, 150% higher valuation than its peers. So for those reasons, I think there's some downside risks with Costco. As I've been talking about that for the last few months, the stock has failed to break out new all-time highs. It also hasn't broken down yet, to be fair. But that is something that we are looking for from a technical perspective. And then lastly, I'll leave you with one last idea here before we wrap up, which is IBM. Looking at IBM, we continue to see some further downside here for IBM as it underperforms the S&P 500. And technology stocks that have taken a bit of a hit recently with their enormous investments in AI. IBM, which obviously has been powering kind of the build out of some of those data centers, have become a bit more under scrutiny as the growth trajectory and expectations for IBM become a little bit more uncertain as investors are being a lot more demanding of businesses controlling their costs for AI spend. And IBM is sort of being caught in the crosshairs at the moment. So in the short run, despite being in a relatively hot industry, along with semiconductors, we see some, in the short run, some further downside risks for IBM. So with that, that covers what I wanted to share with you here today. I hope this is helpful in giving you a better understanding of where we currently stand with the equity markets. A lot to cover, a lot to look at here this week. So we will be back here next week to update you once the election is over and the FOMC meeting is over and kind of where we currently stand and our outlook going forward. With that, thank you so much and have a great trading day.